Before you scroll past this, before you dismiss what I'm about to tell you as just another market analysis, I need you to understand something crucial. What unfolded in the silver market wasn't what they told you it was. The story you heard, the explanation that flooded every financial news outlet, the comfortable narrative that made everything seem routine and predictable, that was the surface. That was the version designed to keep you calm, to keep you from asking the right questions, to keep you from seeing what was actually happening beneath the headlines. This moment we're dissecting today, this so-called routine rebalance that supposedly meant nothing, this was a crack in the facade. It was a pressure valve releasing steam before something bigger could rupture. And if you can learn to recognize these moments, if you can train yourself to see past the explanations and into the mechanics, you'll be positioned ahead of the crowd every single time. My channel is Dark Economy, and on this channel, we don't chase headlines. We don't react to the noise. We study the architecture of markets, the incentive structures that drive behavior, the pressure points that build silently until they can no longer be contained. We look at what's actually happening, not what we're being told is happening. And if that approach resonates with you, if you're tired of being 2 steps behind every major market move, then hit that subscribe button right now, because what I'm about to break down over the next 30 minutes will change how you see not just silver, not just commodities, but how you understand market manipulation, narrative control, and the silent transfer of wealth that happens when most people are looking the other way. I want you to think about something for a moment. When was the last time you saw coordinated, urgent messaging about a routine event? When did a scheduled, predictable mathematical adjustment require emotional language, dramatic framing, and synchronized delivery across multiple platforms? Normal events don't need that kind of reinforcement. Stability doesn't require persuasion. Well, when markets are functioning smoothly, when events are truly routine, there's no need to convince anyone of anything. The numbers speak for themselves, the mechanics play out quietly, and life goes on. But yesterday was different. The tone shifted. The language became urgent, absolute, designed to trigger a specific response. And that shift, that emotional escalation around what should have been a completely mechanical process, that's your signal. That's how you know something else is happening. Markets don't speak emotionally unless there's pressure underneath. Systems don't deploy fear unless someone needs liquidity. And urgency only appears when windows are closing, not opening. So let me take you behind the curtain and show you what actually happened. Let me walk you through the mechanics, the timeline, the positioning, and most importantly, the incentives. Because once you understand the why behind the what, you'll never look at market events the same way again. The Bloomberg Commodity Index. On the surface, it's just a benchmark, a mathematical formula that weights different commodities based on their market performance and liquidity. It's systematic, rule-based, emotionless. The index doesn't make decisions. It follows protocols. And one of those protocols is periodic rebalancing to ensure no single commodity becomes overweight relative to the others. This isn't new information. This isn't a surprise. The rebalancing schedule is published, the methodology is transparent, and professional money managers have known about this particular adjustment for months. Silver had performed exceptionally well. Its weight in the index had grown beyond the threshold. The rebalancing required trimming that exposure. Mathematical, mechanical, predictable. So why did this predictable event generate so much noise? Why did the messaging shift from analytical to urgent? Why did fear become the dominant narrative? Because the selling wasn't the story. The positioning behind the selling was the story. And that positioning revealed something uncomfortable about market structure, about leverage, about who was caught on the wrong side when the music stopped. Let me explain this carefully, because this is where most people get lost. The Bloomberg Commodity Index rebalancing didn't cause panic. It was the excuse for panic. The actual pressure had been building for weeks, quietly, in the derivatives market, in the options chain, in the leveraged positions that had accumulated during silver's rally. Smart money, the institutional players who actually understand market mechanics, they saw this rebalancing coming from a mile away. They didn't wait until the last minute. They didn't need urgent warnings. They adjusted their positions weeks ago, slowly, methodically, without fanfare. The urgency you saw yesterday wasn't for them. It was aimed at a different audience entirely. It was aimed at retail traders who chase momentum, at leveraged speculators who were late to the party, at anyone holding positions that needed to be shaken loose. Fear is a tool. Urgency is a weapon. And both were deployed with precision to create liquidity where liquidity was needed. Think about it this way. If you're a major institution and you know forced selling is coming, what do? You position yourself to buy that forced selling at the best possible price. You don't bid aggressively and drive prices up. You let the selling exhaust itself. You let fear do the work. You wait for the mechanical sellers to finish their mandates, for the leveraged positions to liquidate, for the weak hands to capitulate. And then, when the selling pressure is exhausted, when everyone who was going to sell has already sold, that's when you step in. That's when you accumulate. That's when you build the position that will profit from the next leg up. This is not theory. This is how markets work. This is how wealth transfers from impatient hands to patient ones, from emotional participants to systematic ones, from those who react to headlines to those who understand structure. Now, let's talk about what makes this particular situation even more interesting. Silver isn't just another commodity. It's not just a store of value or an industrial input. It's a critical material in the energy transition, in electronics manufacturing, in solar panel production, in the infrastructure that's being built right now to support electrification and renewable energy. The physical demand for silver is structural, not cyclical. It's growing, not shrinking. And that physical demand doesn't care about index rebalancing. It doesn't trade based on fear. It secures supply based on necessity. So you have this fascinating dynamic playing out. On one side, you have paper markets, derivatives, financial instruments that are leveraged and sentiment-driven. These markets can swing violently based on positioning, on forced selling, on narrative control. They're loud, they're emotional, they generate headlines. On the other side, you have physical markets, actual metal moving from producers to end users, supply chains that need consistent material, industrial buyers who plan years ahead. These markets are quiet, steady, and fundamentally inelastic. They don't panic. They accumulate on dips. And here's what most people miss. Every time there's a forced selling event in the paper markets, every time leverage gets flushed out, every time weak hands capitulate, physical metal moves from those who don't need it to those who do. It moves from speculative positions to strategic reserves. It moves from available supply to locked-in demand. And each time that happens, the flexible, readily available supply shrinks just a little bit more. This is the structural shift that doesn't get discussed in mainstream financial media because it's inconvenient to the narrative. The narrative wants you to believe that price volatility reflects changing fundamentals, that selling pressure means weakening demand, that dips are warnings rather than opportunities. But if you actually understand the underlying physical dynamics, if you track where metal is moving rather than just where prices are going, you see a completely different picture. You see tightening supply. You see growing strategic accumulation by entities that aren't trading, they're hoarding. You see industrial users extending their supply contracts, paying premiums for guaranteed delivery, building inventory buffers, because they understand that availability matters more than price when your production depends on it. You see Eastern buyers, particularly in Asia, systematically accumulating Western supply whenever paper market volatility creates attractive entry points. This isn't speculation. This is documented behavior that you can track through import data, through inventory reports, through the premiums physical metal commands over paper prices. The divergence between paper and physical markets has been widening. That divergence is a signal. It tells you where the real value is, where the strategic positioning is happening, and most importantly, where the pressure will eventually manifest. Because here's the thing about finite resources. Paper markets can create infinite claims. You can trade more silver on paper in a single day than exists in total global inventory. You can leverage those positions, multiply exposure, create complex derivative structures that promise delivery without actual metal backing them. This works beautifully as long as nobody asks for delivery, as long as everyone's content to settle in cash, as long as the game continues. But what happens when that changes? What happens when physical demand exceeds available supply? What happens when strategic buyers decide they want actual metal, not promises? What happens when the industrial users who need silver for production can't get it at any price because all the readily available inventory has been locked up? That's when the paper markets discover they've been playing a very different game than they thought they were. That's when the leverage that seemed so profitable becomes catastrophic. That's when forced liquidations happen, not because of scheduled rebalancing, but because promises can't be kept. And that's when prices don't just rise, they gap, they dislocate. They move in ways that break models and trigger cascading failures across interconnected positions. I'm not predicting that tomorrow. I'm not calling for an imminent squeeze. What I'm telling you is that the structural conditions for that kind of event are being built right now, trade by trade, rebalance by rebalance. Every time weak hands sell to strong hands, every time paper positions get flushed and physical positions get accumulated. And events like yesterday's, these supposedly routine rebalances that generate outsized fear and urgent messaging, these are symptoms of the underlying pressure. They're small releases of steam before the pressure cooker truly heats up. They're warnings for those who know how to read them. Let me share something with you that I've learned from years of studying market structure. The market doesn't move based on what's happening right now. It moves based on what's coming next and who knows about it first. Information asymmetry isn't about having secret data. It's about understanding what public data actually means. It's about recognizing patterns that repeat across different markets and different time periods. It's about understanding incentives, about knowing who needs what and when. The urgency yesterday wasn't random. The coordinated messaging wasn't coincidental. The fear wasn't organic. These were tools deployed to achieve specific outcomes, and the outcome wasn't protecting retail investors from a routine index rebalancing. The outcome was creating liquidity at favorable prices for those positioned to take advantage of it. This happens over and over again across every market. Volatility events that seem chaotic are often highly organized. Panic that appears spontaneous is often strategically triggered, and narratives that dominate financial media often serve specific interests that aren't immediately obvious. Your job as a participant in these markets isn't to trust the explanations you're given. Your job is to ask who benefits from those explanations, what behavior they're designed to trigger, and what opportunities they create for those who see through them. If you're still watching this video, if you've made it this far, then you're the kind of person who wants to understand, not just react. You're the kind of person who recognizes that surface-level analysis leaves money on the table. And you're the kind of person who would benefit from subscribing to this channel because this is exactly the kind of deep structural analysis we do every single video. Hit that like button right now if this perspective is valuable to you. Share this video with someone who's still reacting to headlines instead of understanding mechanics. Drop a comment telling me what market you want me to break down next, what event seemed confusing, what narrative doesn't quite add up. Your engagement tells the algorithm that this content matters, that this analysis has value, that there's an audience for truth over noise. Now, let me take this analysis one layer deeper because we need to talk about what comes next. The selling pressure from the index rebalancing is finite. It's not ongoing. It's not perpetual. There's a specific quantity that needs to be sold, and once that selling is complete, it's done. Mechanical sellers don't have opinions. They don't wait for better prices. They execute their mandates and move on. So what happens after mechanical selling is exhausted? The market character changes. The selling pressure that was keeping prices suppressed disappears. And if underlying demand is still intact, if physical buyers are still accumulating, if strategic interests are still building positions, then prices don't stay down. They recover, often quickly, often in ways that leave those who sold into the fear scrambling to get back in at worse prices. This pattern repeats consistently across commodities, across equities, across every market with forced selling dynamics. The dip happens. The fear peaks. The news flow becomes maximally negative. And then, when sentiment is most bearish, when everyone who was going to sell has already sold, that's when the reversal comes. I'm not telling you to buy silver. I'm not giving you financial advice. What I'm doing is showing you a pattern, a market structure, a setup that creates asymmetric risk reward for those who recognize it. What you do with that information is your decision. But make sure it's an informed decision based on understanding, not a reaction based on fear. Let's talk about the bigger picture for a moment because silver doesn't exist in isolation. The energy transition, the infrastructure spending, the push for electrification, these are multi-decade trends that require massive amounts of industrial metals, copper for wiring, nickel for batteries, lithium for energy storage, and silver for solar panels, electronics, and conductive applications that have no viable substitutes at current price points. These demands aren't going away. They're accelerating. And the supply side isn't keeping pace. Mine production is relatively inelastic. You can't just decide to produce more silver overnight. It takes years to bring new mines online, and existing mines are depleting. Recycling helps, but doesn't come close to meeting incremental demand. So you have growing structural demand meeting relatively fixed supply. Basic economics says that creates upward price pressure over time. But markets don't move in straight lines. They oscillate. They experience volatility. They have periodic shakeouts exactly like what we saw yesterday. And those shakeouts, those fear events, those moments of maximum pessimism, those are the opportunities for those who understand the long-term trajectory. This is what separates traders from investors, speculators from strategic accumulators. Traders react to volatility. Investors use volatility. Speculators chase momentum. Strategic accumulators build positions when prices are suppressed by temporary factors that don't change the fundamental thesis. Think about who was buying yesterday. Not panicking, not liquidating, but actually accumulating. It wasn't retail traders watching financial news and reacting to fear. It was institutional buyers with long-time horizons, industrial users securing future supply, and strategic interests who understand that temporary price dislocations created by forced selling are gifts, not warnings. This is the game within the game. The surface game is about price movement, volatility, headlines, reactions. The deeper game is about understanding why prices move, who needs what to happen, and how to position yourself accordingly. Most people play the surface game. A small percentage play the deeper game. And the deeper game is where real wealth is built. I want you to remember something important. Every major market opportunity in history looked scary at the time. Every significant bottom was characterized by maximum fear, bearish consensus, and widespread belief that prices would go lower. And every time, those who bought when others were selling, who accumulated when others were capitulating, who understood structure when others were reacting to sentiment, those were the ones who profited most significantly. This doesn't mean every dip is a buying opportunity. It means you need to distinguish between dips caused by changing fundamentals and dips caused by temporary technical factors like forced selling. The former require reassessment, the latter require patience and conviction. Yesterday's event was technical, not fundamental. The underlying drivers of silver demand haven't changed. The supply constraints haven't disappeared. The structural thesis is intact. What changed was positioning, leverage, and near-term sentiment. Those are temporary factors. They create noise, not signal. Now, I know some of you are thinking, if this analysis is so clear, why doesn't everyone see it? Why do fear events work if the pattern is so obvious? The answer is simple. Knowing intellectually how markets work and maintaining conviction when fear is peaking are two completely different things. It's easy to be rational when markets are calm. It's exponentially harder when prices are dropping, when news flow is negative, when everyone around you is panicking. This is why discipline matters. This is why having a framework, a systematic approach, a clear understanding of what you're looking for and why you're positioned the way you are, this is what allows you to act when others are paralyzed. This is what separates those who profit from volatility from those who are destroyed by it. Your emotional state should never determine your market decisions. Fear and greed are terrible advisors. They cause you to sell bottoms and buy tops, to panic at exactly the wrong moment, and to get complacent when you should be cautious. Systematic thinking, structural understanding, and disciplined execution, these are what allow you to navigate markets successfully over time. Let me give you a framework for thinking about events like yesterday. First, separate signal from noise. Ask yourself, does this event change the fundamental thesis? Does it alter the long-term supply-demand dynamics? Does it represent new information or just new positioning? If it's not fundamental, it's noise. Noise creates volatility, but not direction. Second, understand the incentives. Who benefits from the narrative being pushed? Who needs liquidity? Who's positioned to profit from fear? Follow the money, not the explanations. The explanations are designed to make you act in specific ways. The money flows show you what's actually happening. Third, recognize forced actions versus discretionary actions. Forced selling is finite and predictable. Discretionary selling based on changing views is neither. Yesterday's selling was forced. That makes it an opportunity, not a warning. Fourth, watch for divergence between paper and physical markets. When paper prices drop but physical premiums stay elevated, when inventory continues to move into strong hands, when strategic buyers keep accumulating despite price weakness, that tells you the paper market is disconnected from reality, and eventually reality wins. Fifth, understand that maximum fear often precedes opportunity. When sentiment is most bearish, when everyone who was going to sell has already sold, when the news flow can't get any worse, that's often when bottoms form. Not always, but often enough that it's worth paying attention to. These principles apply across markets. They're not specific to silver. You can use this framework to analyze any situation where forced selling creates volatility, where narratives seem disconnected from mechanics, where fear appears disproportionate to events. This is the value of understanding structure. It gives you a lens for seeing through the noise. It gives you confidence when others are uncertain. It gives you the ability to position yourself advantageously while others are reacting emotionally. Before we wrap up, I want to address something directly. Some of you might be thinking this sounds conspiratorial, that I'm suggesting markets are manipulated, that there's some coordinated effort to mislead participants. That's not what I'm saying. What I'm describing is how markets actually work. It's not conspiracy, it's mechanics. Large institutions have different information, different time horizons, different resources than retail participants. They act in their own interest. They position ahead of known events. They use volatility to improve their entry points. This isn't nefarious. This is literally their job. And narratives emerge that serve those positioning interests, not because of some shadowy coordination, but because incentives align and behavior follows. Your disadvantage isn't that you lack some secret information, it's that you're not thinking structurally about how markets function, about who needs what, about how forced events create opportunities, about how fear and urgency are used to trigger liquidity. Once you understand these dynamics, once you train yourself to see past surface explanations, you're no longer at a disadvantage. You're just playing a different game than most participants. And that's what this channel is about, teaching you to play that different game, giving you the frameworks, the perspectives, the structural understanding that allows you to navigate markets with confidence instead of anxiety. This isn't about get-rich-quick schemes or hot tips. This is about building genuine understanding that compounds over time and allows you to recognize opportunities that others miss. If that resonates with you, make sure you're subscribed. Make sure notifications are on. Make sure you're engaging with this content through likes, comments, and shares, because that's how we grow this community of people who think differently about markets. Let me leave you with this final thought. Markets reward patience, discipline, and understanding. They punish reactivity, emotion, and surface-level thinking. Every volatility event is a test. It tests whether you'll stick to your framework or get swept up in the moment. It tests whether you understand structure or just react to sentiment. It tests whether you're thinking long-term or just responding to short-term pain. Yesterday was one of those tests. Those who understood what was actually happening saw opportunity. Those who only reacted to headlines experienced fear. The difference wasn't access to special information. It was perspective, framework, understanding. That's what I'm offering you here. Not predictions, not guarantees, not financial advice. Just a different way of seeing markets, a structural approach that cuts through noise and helps you identify what actually matters versus what is just temporary volatility. The silver market will continue to evolve. There will be more volatility events, more fear narratives, more moments that test your conviction. And each time, you'll have a choice. React emotionally or analyze structurally. Follow the crowd or understand the mechanics. Play the surface game or play the deeper game. I know which choice leads to better outcomes. And I think you do too. That's why you're still here. That's why you watched this entire video. That's why this analysis resonated with you. Because deep down you know that something isn't quite right with the explanations you're given. You sense that there's more happening beneath the surface, that the comfortable narratives are too convenient, too perfectly timed, too synchronized to be purely organic. And that instinct, that feeling that you're not getting the full picture, that's not paranoia. That's pattern recognition. That's your mind telling you to look deeper. Let me tell you what separates those who consistently profit from markets from those who consistently struggle. It's not intelligence. It's not access to information. It's not luck. It's the willingness to question consensus, to examine the mechanisms behind market movements, to understand that prices are not random fluctuations, but the result of specific actions taken by specific participants with specific motivations. Once you accept that markets are not mystical or unpredictable, but rather logical systems driven by incentives and constraints, everything changes. You start to see patterns where others see chaos. You recognize setups before they become obvious. You understand that volatility is not risk, it's opportunity, as long as you're positioned correctly and thinking clearly. The challenge is maintaining that clarity when everyone around you is panicking. When prices are moving against you temporarily, when the narrative is overwhelmingly negative, that's when your framework matters most. That's when understanding structure separates you from the crowd. Think about what we've covered in this analysis. We've looked at how scheduled events generate disproportionate fear. We've examined why mechanical selling creates opportunity rather than risk. We've explored the divergence between paper and physical markets. We've discussed how narratives serve positioning interests. We've revealed how urgency signals closing windows rather than opening dangers. Each of these concepts is a tool in your analytical toolkit. Each one helps you navigate future events with greater confidence. And here's what's important to understand. This framework isn't specific to silver. It's not limited to commodities. It applies to equities during margin calls. It applies to currencies during intervention. It applies to bonds during forced liquidations. It applies anywhere. Forced selling meets strategic buying. Anywhere temporary technical factors create disconnects from fundamental value. Anywhere fear is used as a tool to transfer assets from weak hands to strong hands.